You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. You know that I love interviewing people in the real estate crowdfunding space. I've had the honor to interview a bunch of the major players, and we've got one of them here today. Adam Kaufman is co-founder and the COO of ArborCrowd. He's also an authority on commercial real estate and crowdfunding. Like me, I think he believes that crowdfunding is just disrupting the commercial space in a really great way. A little bit about ArborCrowd. It's part of the Arbor family of companies, which includes the Arbor Realty Trust, which is a publicly traded commercial mortgage real estate investment trust. And we'll go into what that means a little bit in the podcast. And just a reminder, there is a review of ArborCrowd on the Millionacres website. Well, welcome, Adam.
Thank you. I'm excited to be here today.
Let's get right into it because I noticed that during the pandemic, ArborCrowd stopped bringing deals to the platform. I thought that was an interesting move. And why was that the right move for you?
You know, at the beginning of the pandemic, there was a lot of uncertainty. The industry really came to a halt pretty quickly. And one of the benefits that we have as a company is that we are able to warehouse our deals, meaning that we actually put our capital on the line into each transaction, close on that transaction prior to syndicating it out to the crowd. What that does is it gives us the ability to take the time we need to launch that product on the platform. So in the beginning of COVID, when there was a lot of uncertainty, the industry came to a screeching halt. We had the ability to put our deals on our balance sheet for all intensive purposes and wait for the best opportunity to launch it to our investors when the dust was settled and we thought it was a more safe and secure environment to do so. But at the same time, we didn't sit back and pause. We decided to focus our internal efforts on building out our technology. We hired up and staffed up to not only build that technology, but to improve our operations across the board. So we weren't sitting on our hands, we weren't resting, we were very active, and we had a cautious and careful outlook towards the market in terms of deals.
I think that's interesting because in the review of ArborCrowd and Millionacres site, we use the word methodical, and I think that's a compliment. I believe that that's what you really, what one of the values of ArborCrowd is. You present only one deal at a time. Why is that?
Our belief is putting the product first. And like I said earlier, we put our money on the line. We actually close on these transactions with private capital prior to syndicating it out. And we do so because we have to believe in the deals and we have an inherent focus on putting the product first, looking out for our investors, not being an expert across the board in every single asset class across different product types, but focusing on what we know best and where we think the money is best suited. There's a lot out there in the industry. We see a lot of deals come across our desk, and we cherry pick the ones that we think are the best for the platform.
When I've talked to other crowdfunders, they talk a lot about that, about how many deals come across their desk. I think that's really something that everybody's focusing on. Is they're seeing a lot of things that maybe aren't right for crowdfunding. What do you see that kind of makes you think, okay, this deal isn't right for me? Is there anything particular that you look for that might be a warning sign or look for that might be an encouraging sign?
Absolutely. I think, when crowdfunding first got started, it's still, in my belief, in its infant stages, taking off very aggressively. And I do think it's the future. In its more infant stages, I think that what was happening for the crowdfunding platforms is that they were often looked at as easy targets for capital because the people running the platforms didn't necessarily have or tout their real estate experience, but actually identified themselves more closely with technology companies or as technology companies, as marketplaces, as mere syndicators, not really with real estate experience. So you had people who were shopping deals around in the market for long periods of time, being denied some of the more traditional sources of capital, revert at the last, at the last stop to crowdfunding platforms. And that was what was happening for a while. That's still happening to a large degree, but I think people are getting more experienced and people are also understanding crowdfunding in general, how it works. It's becoming more of a topic that's discussed around I guess just the table in general in boardrooms for people to come together and look at it as a viable source of capital. So with that said, I think the quality is coming, is growing. We have a lot of relationships in the industry. It's something I know we'll talk about a little bit more as it relates to how we work with the Arbor Realty Trust and the synergies that exist there. But because of that, we're able to really cherry pick the deals that we think are the best. And the fundamentals of the deals have to be there. We have to be able to say to ourselves, are we willing to put money on the line, because that is what we do prior to syndicating it out.
So I know that one of the things you talk about with ArborCrowd is making sure everyone has skin in the game. That's you guys putting capital in, but what does that mean across the entire deal?
Yeah, that's a great question. And I think that's often overlooked when people are analyzing deals on different platforms. At the end of the day, you have to look at who is running the deal, who's the sponsor, how much money are they investing in the deal. We syndicate, we invest in the deal prior to syndicating, but we also have benchmark requirements on a deal by deal basis for the amount of equity that the sponsor is putting in. And that's really important. And it's to know that the interest is aligned, that there is an inherent combined interest for the business plan to succeed. Their capital is on the line too. And what you have to really be careful is understanding the fees. If, for example, the acquisition fee is so close to the amount of equity they're putting in the deal, they're essentially getting cashed out right at the start of the deal. And their interest doesn't need to be there in such a strong degree. You have to really dive in, ask the questions, and most of all, be made sure that the information is being presented to you.
That's one of the things that we've learned in the Mogul service, and one of the things that our investors talk about is that it's confusing in the beginning when you're understanding crowdfunding, is just understand what the sponsor promote is, what that means, what the waterfall is. There's a lot of sort of terms that may not make sense to people. How do you sort of help your investors understand that?
One of the things that we tout ourselves on is presenting a lot of information. And we're able to do that because we close on the transactions. The deals are, fully baked. We can present all of the information as is. It's not a moving target. Things aren't changing. And it's not, we don't raise the capital prior to finding the deal. It's the opposite. So with that, we're able to put together, even 30-page summaries of the actual deals. We're able to put together private placement memorandums on each deal that are 150 to 250 pages, depending on the deal, where you have access to a lot of information. Now, with that said, not everybody needs to become an expert in real estate overnight. And the key is to ask yourself, is the information being presented to me? If I have a question, can I speak to someone? Am I getting real and valid answers? And am I comfortable partnering with this person at the end of the day, or this firm? Do I feel comfortable with the overall business plan, the overall market? And if that information or that level of comfort doesn't exist, you should proceed with caution.
I would definitely agree with that. So you and I both believe real estate crowdfunding is, you said it's in its infancy. I think it's sort of like, maybe it's a toddler at this point. It's definitely learned to crawl. It's starting to run. I have this theory that REITs were created in the 1960s. It really took REITs like about 30 years to kind of take off as an investment. How long do you think it's going to take for real estate crowdfunding to really sort of catch the eye of more people? I think it's still a little bit on the fringes. What do you think?
I agree. I think we haven't even scratched the surface. I think the power of the quote retail investor is enormous. And the whole concept of crowdfunding came about because of technological advances and having accessibility at your fingertips. And I think that's only going to grow. Now, it is the Wild West out there. There's a lot of regulation that I think needs to come into play to really, make sure the space operates in the right way. As that happens, different companies and people will adapt, and people will ultimately feel more comfortable. People on the other side, the sponsors, need to be assured that it's a secure and actual realistic way of raising capital. And I think that's proven correct. But the retail investor exists in a great, great quantity. And we're just scratching the surface. And I think, if you were to look at how much is being raised through crowdfunding, the year over year growth and what that multiple looks like, it's moving quickly. It's moving quickly.
One of the things I think that sponsors maybe feel a little bit hesitant about is just the amount of investors in a deal. I think that they're so used to having to please a few stakeholders. Do you find there's a reservation with some sponsors in that idea of suddenly having 50 stakeholders that they now sort of can expect questions from or something like that?
Definitely, I find there is a reservation, but I think it's often a misunderstanding, and that depends obviously on how the platforms operate. But what we do is we, as ArborCrowd, um, actually represent when we are talking to sponsors. We are communicating with the sponsors. We're actually asset managing the projects. It's something that we tout in our experience and in our ability. Is that you're speaking to us, we speak on behalf of the crowd, we deal with all of that communication, and people want that. Not only do sponsors want that, our investors want that because they feel comfortable and confident that we know the questions to ask. We know how to stay on top of our sponsors and make sure that we're getting the proper information each quarter and regularly when things happen. And that because we know what we're doing, they're able to feel more comfortable at home. And that's really what we do. We focus on the real estate itself. For example, we had a deal that we entered, and in about just under 15 months, the business plan of that deal changed. That was not the deal that we entered into, and that's not how we sold it to our investors. So we went to the table, we spoke with the sponsor, and we were able to negotiate a favorable outcome across the board for our investors to exit the deal because the business plan had changed on their behalf. And that's a really, really big deal for our investors who wouldn't even have known that they had the ability to do that, let alone track the business plan in that way. That's an example of how we're different. It's an example of how we asset manage and how we actually put our, get to the table and are able to really get in the weeds.
That's interesting because one of the things we've seen with Mogul, and I think this is a reflection of the deal climate right now, is some of our deals that were originally going to be maybe a 5-year hold or something like that, especially in multifamily. We're seeing things be sold quickly. We're seeing those timelines kind of shift. Is that sort of what you're seeing too? Is it business plans and also timelines kind of shifting partly due to the pandemic?
Yeah, I think across the board, things are changing. We definitely look at, for the most part, our deals have stayed pretty steady in terms of their business plans, and we feel really good about that just because we know that it ensures us that we understood and partnered up in the right way, and we're on the same page. But that obviously is very different across the asset classes. In multi, we've been fortunate in that way. Obviously, retail hospitality affected by the pandemic, incredibly different. I hope that people were very nimble in addressing those concerns. But across the board, I think it is a unique position to be in. I think things are changing, and you have to have the ability to handle that change, but make the right decisions, and that comes down to experience.
Well, let's talk a little bit about being part of the Arbor group of companies and what that means for ArborCrowd.
Yeah, so first and foremost, we share common leadership. And what that really means is that we not only have a huge bank of relationships and access to deals, so we don't have the same expenditure in that way of attracting sponsors and quality deals. It kind of flows in from so many years of relationships that we've had. And one of the things that's very unique about Arbor is they've survived multiple market cycles, but they really are hesitant to take on new clients. A lot of their relationships have existed through those market cycles. So they understand how their sponsors perform. And that's something they learned from 2008 really is that, understanding people, keeping, consistent clients is very important. We can tap into that. We can tap into those deals. It's incredibly powerful. It's an incredibly powerful network. And we also have the experience across the board through those multiple market cycles. Our focus has always been multi primarily. I personally believe it's very difficult to be an expert in every asset class and in every product. And therefore we keep our focus, pretty narrow and concentrated. But with that said, multi tends to be the safest and most secure asset in the asset class in real estate. So it's good across the board. we have a wealth of relationships and a wealth of experience, and that's benefited us and our investors tremendously.
Why was it important for the Arbor Group to have a real estate crowdfunding platform?
I get asked that all the time. I think, for Arbor is always looking, it's a unique company in that it's always looking to understand where the market is and where it's going. I identified an area where there was a new source of capital that could help, in general, the need in the marketplace to fill the equity gap. Originally, this is what we set out for, to fill the equity gap for sponsors who are looking to take down deals and they couldn't raise, $3, $4, $5 million additionally from their networks or family and friends or put it up personally. And there was a need for that in the market. That's where we came in. And we knew that this was going to be a growing source of capital as we're seeing right now and the power of the retail investor. So it was only natural that, that we would start the platform.
That makes sense. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Some of our listeners are undoubtedly among the fortunate group sitting on piles of valuable tech stock. If you're one of them, listen up. Urban Catalyst could help you with your tax bill when it comes time to sell. Urban Catalyst is the premier qualified opportunity zone fund based in Silicon Valley. And if you meet investors' qualifications and invest in a qualified opportunity zone fund, you could potentially get big tax breaks. Here's how it works. When you go to sell your stock, you will likely generate a large capital gains tax bill, which means Uncle Sam may want to take a large chunk of it. If you're not keen on sending all that money to the U.S. Treasury, Opportunity Zone funds like Urban Catalyst can help you shield those gains. And Urban Catalyst isn't just any Opportunity Zone fund. Forbes magazine and the Sorensen Impact Center ranked Urban Catalyst one of the top 20 OZ funds in the country. Don't wait too long. If you invest before the end of this year, you may not only defer capital gains taxes, but you also may be able to reduce your capital gains by 10%. And as an added incentive, if you hold your investment for 10 years, you will likely not have to pay any federal taxes at all on those gains. And it's not just stock sales. Capital gains from real estate sales, selling your business, or even a big crypto sale, these types of capital gains can all get potentially favorable tax treatment by investing in an Opportunity Zone fund. Urban Catalyst focuses on development in downtown San Jose, an area prime for growth and revitalization. You can learn more about the fund and the numerous development projects underway by visiting urbancatalyst.com/millionacres. But keep an eye on your calendar. You only have 180 days after your capital gains event to invest in an Opportunity Zone program. So visit urbancatalyst.com/millionacres today.
I'm back with Adam Kaufman of ArborCrowd, and we're talking about real estate crowdfunding. So currently, you guys are only for accredited investors. Do you think that that's going to shift over time?
I don't think we will move over time to not accredited investors. It was very intentional for us to go towards accredited investors. I think we can all agree that the definition of an accredited investor is incredibly broad and really makes very little sense. And I hope that gets refined over time. But at the end of the day, you have two things that are pushing, that are consistently pushing us to staying towards accreds. One is the cost to acquire a non-accred is virtually the same as the cost to acquire an accred from a digital acquisition standpoint or a customer acquisition standpoint. And you want to focus your energy on a higher check if you're able to. Number two is that at the end of the day, if you go ask an accredited investor, do they make other investments? Is real estate, we're pitching that real estate's a way to diversify. What other investments do they make? And you'll get a wide slew of answers. They deal with different brokers. They deal with other types of investments. Maybe it's in funds, whatnot. That makes me feel comfortable at the end of the day that they have investment experience. And it's not me taking the risk for the first time of walking them through an investment channel. Where if you go to a non-accredited and you ask that question, oftentimes, you'll get an answer like I own some Apple stock, or, I bought bonds or treasuries back a while ago, or I got that as a present when my kid was born, et cetera. I think that there's more risk there, and I am a little cautious to be pitching an investment channel to somebody who is not actively looking, and they basically saw an advertisement and clicked through, and all of a sudden they put in $1,000. So that's really the two things at the end of the day why I think we'll continue to focus on accredited investors.
That makes sense. What's the average minimum per deal for ArborCrowd?
It ranges. So our minimum ask is 25,000. We've gone up to 35, and that changes based on the amount of money we're looking to raise or the interest there. And at the end of the day, for us, our average has been higher. Our average has been a little over 50K actually.
So I know one of the things that you've advocated for is more transparency in crowdfunding. You just mentioned advertising. There's a lot of companies are spending a lot of money advertising right now. What does transparency mean to you, and what ways do you think that the industry needs to kind of think about it as it grows up?
Transparency means information. The whole point of crowdfunding is to have access and information at your fingertips without a middleman. And to me, you need more information on a deal by deal basis, on an investment type basis. That's just lacking. A lot of platforms out there, they either don't have the information, they're presenting tear sheets because they're raising the capital, in which case the investor needs to be able to understand who that crowdfunding platform is, what is their real estate experience. That needs to be marketed to them more heavily if they're raising the money up front. On the flip side, if they are actually investing in a deal, they need to be able to know and understand what they're investing in. And that also comes down to the experience of the platform. How well did they vet this deal? Do they know how to vet it in the same way? What happens after I invest? What does our relationship look like? What's the communication look like? What am I getting from them? Because the relationship really starts at the investment point, not before that. So I think those things really need to further grow in the industry, and that to me is a hurdle that many are hopefully they're not accomplishing, but will hopefully in the future.
Well, you mentioned earlier before the break, we were talking about how many materials you put on your site with, the memorandum and things like that. People don't always read that stuff, it's sad to say. So how can they manage that? What should they be looking for when they're seeing all of that paperwork? They're seeing diagrams and plans and talk about floor plates, and it all kind of sounds a little confusing if you haven't dealt with real estate before.
So the key to me is if you can't understand something or something seems overwhelming to you, you should be able to get on the phone with somebody and somebody should be able to walk you through it. And if you can't get that for yourself from the platform, then there's a problem. Now, that doesn't mean that somebody should go to school for real estate in general on the phone with somebody, right? It's not a class, where you're committing an enormous amount of time. But basic questions, hey, walk me, what's the business plan in a nutshell, depending on what level of depth you want to get into? Who am I partnering with? What's their experience? What's their track record? What's your track record? What's your experience? Those questions should be able to be answered. And that should, it could be a 2-hour call, it could be a 20-minute call. And at the end of the day, there shouldn't be a non-answer on the phone. There should be answers. And I think that people should require that for themselves.
I think that's really true. One of the things that we've learned with Mogul and with Million Acres too is sponsor communication. In the beginning, when we were launching Mogul, it wasn't something that factored into our Mogul score of evaluating things. It's later become something that we really think about because we've had some sponsors that haven't been that communicative with changes and things like that. Is that something you've noticed too? Is sponsor communication something that you look for kind of ahead of time?
Absolutely. And we inform the sponsors, and we do that on behalf of our investors. So we communicate with the sponsors and go back to our investors. Our sponsors know very well what our requirements are when we are negotiating up front. They sign the documents that basically say, I will meet these requirements. I will communicate with you on X, Y, and Z basis. Should X, Y, and Z change, I will communicate with you and come to you. Those are things that we put in writing. It's really important for us. And because we have such deep-rooted relationships with a lot of our sponsors, we don't have any problems across the board. We've been very fortunate, and that is definitely something we look out for.
Interesting. Good to know, because I think it really is something that can make a big difference in terms of understanding investments and in terms of investor comfort as well.
Yeah, I mean, even look back, we just had, I'm in New York, We had, the hurricane this past week, right? We have properties that are in pathways to the hurricane. We have had them in the past. We have them today. Are we able to get on the phone with the sponsor and make sure that, things are in place? Are they concerned? How are they preparing after the fact? What was damaged? How are the repairs looking? Anything significant? Those types of communications are essential because life happens.
That sort of makes me think about climate change a little bit because you're invested in workforce multifamily, which is so smart in this current environment. We've got an interesting situation where people seem to be moving to places that are, in many cases, most impacted by climate risks. So you're kind of balancing a bunch of those factors. How are you and the ArborCrowd team thinking about those two factors and the ways that they sort of can kind of conflict each other?
That's a great question. I by no means will credit myself with being an expert in climate change, but we absolutely do the analysis, of course, on a deal by deal basis. We do the right assessments and the right reports to make sure we're not in those areas. But that would go down to the fundamentals of the deal and do we believe in it? And if there's no longevity there because the climate poses a risk, we won't make that investment.
What markets are particularly interesting to you right now?
We have a unique investment thesis in that we look for, again, at the fundamentals of each deal. And when a deal is good, we jump on it and it's relationship based for us. So it's who's bringing us the deal, how much do we trust them, what does their past track record look like. So right now we've been seeing a lot come from the Sun Belt area in general, but again, it's relationship based and deal quality based. That's worked well for us. Other people have different approaches that works well for them. We're fortunate on the relationship side.
Are you factoring in remote work and some of the migration we've seen in the last year? Do you feel like that's a temporary trend, or is it something you're starting to consider for the future?
I do. I think that remote work is largely temporary, but there will be shifts. You will see, certain flexibility. The 5-day week might change for certain people in office, but I do think it's largely temporary. But with that said, there are other unique patterns that I think COVID accelerated, like family formation. Millennials who are looking to live in homes, maybe can't afford a down payment, but want the same amenities, are looking at built to rent, single family rentals, built to rent space. That's really hot right now. I think that people don't realize how large SFR is across the market in general. But it is a big sector. I think that trend was accelerated and heightened in COVID, and I think that is here to stay.
Yeah, absolutely. We've seen so many funds pop up in the last year for, billions of dollars to amass these single-family rentals in a lot of places. It's really an interesting phenomenon. You mentioned build to rent, and that's something we're seeing as well. So when you're looking at workforce housing, are you looking at ground up development, opportunistic, value add? What types of deals appeal to you? Is it just depending on the relationship, or is there something that you particularly look for?
When we first started, we focused primarily on value add. That market's gotten the returns in that market have gotten incredibly thin. There's a lot of competition, and it's hard to hit where the investor in the crowdfunding space is looking for a net of fees IRR, in the mid to high teens. That's virtually impossible to find right now. So we've shifted. We've done a construction deal. We're looking at more construction deals, and we're looking at more opportunistic stuff in general.
Are you looking at single family like communities or build to rent or any of that?
We are heavily looking at those, and that I think is going to be a lot of the focus of our platform going forward. We have relationships there. There's a lot of opportunity there. And we just love the concept, and we think it's here to stay.
Yeah, I would absolutely agree with that. Let's talk about opportunity zones. I feel like everybody wants opportunity zone deals. I think finding them is certainly a challenge. Some of the interest seems to have waned, but then I just got done with a mogul webinar earlier, and a lot of our members were talking about wondering if we had any opportunity zone deals that we were looking at across the different platforms. What are you seeing as far as opportunity zones?
My outlook towards the opportunity zone deals and the program in general when it was first created is the same today as it was then. And to me, it's all about the fundamentals of a deal. The opportunity zone component is just gravy. So if we find a deal that we think has strong fundamentals, you have to remember a lot of the opportunity zone deals are inherently in riskier markets. And I think a lot of the good ones, quote unquote, have been eaten up, have really been done. You also have time working against you here. As the years go on, the tax benefits, stepped up in basis component gets lower. So I think at the end of the day, it's gravy. We underwrite to the fundamentals. If it is an opportunity zone, we will add that on top. But we'll market the deal with its fundamentals, and it would be a separate page about the opportunity zone. We wouldn't go out and market the opportunity zone first.
Are there any other tax credit programs that you're looking at?
Not per se. I think more for us, it's sticking to the fundamentals of the deals. And if the tax credit stuff exists, great. If there's anything from like a historical tax credit that exists, or you're able to get some tax credits because you have some of the like a well tower or something like that in your property, that's great. But again, we revert back to the fundamentals. That's how we market it, and we'll just say there's a chance or there's an ability perchance of accomplishing this tax benefit. We'll shoot for it, but we're not going to promise it.
What are you thinking about interest rates and inflation? It seems like we're at the beginning of some sort of movement here. Interest rates have been so low. It seems like they're going to start to tick up slowly. Does that impact your business at all?
It does. It is my belief that interest rates will go up as we're seeing that happen. The pace of which will be determined. And I think inflation is a sure thing. I think that's why I would encourage people to diversify their portfolios with real estate. Real estate traditionally acts as a hedge against inflation. That's very important to know. And I think that it's inevitable. I think there's a lot of money being printed.
What kind of hold times are there on ArborCrowd deals? Are you holding until they're leased up, or are you holding after that?
It depends. For the most part, our deals have ranged in hold periods anywhere from 3 to 6 years. Obviously, a construction deal has a longer hold period, so it also depends on the business plan largely. But yeah, I think we look to be in the deal until stabilization, until it's sold, really. But if that doesn't happen, we also have the ability for us to talk to sponsors to negotiate a certain buyout at achieving a certain IRR, so that we always leave that flexibility in for ourselves.
Another question that we get a lot at Million Acres is about taxes. People are very concerned about dealing with K-1s and being able to invest SDIRA Capital. What do you tell people about taxes and real estate crowdfunding, and what should they be aware of?
First and foremost, I always tell people that they should talk with tax experts. I noticed that you can get into trouble when you start to go down that route, and it is complicated, and we are not tax experts. But with that said, we do facilitate K-1s for our investors in the properties. That's incredibly important, and we do accept self-directed IRAs to come through the platform. Outside of that, we really leave the tax advice up to the tax people.
That's smart. So do you do SDIRA Capital on every deal? It doesn't vary by sponsor?
We accept it if they come in. We're not a broker-dealer, and we're not a registered investment advisor. So if they come in, basically they go to their IRA and they say, I want to make this investment. Their IRA allows for it. They can come in through the platform that way. But we don't work exclusively with one, and we don't broker through one.
That makes sense. So right now you do one deal at a time. Any plans to change that?
We are changing that as we speak. It was about, for me, building a company in the right pace. I fortunately am privately backed, so I don't have to show a rapid pace. I'm trying to build a long-term business based on fundamentals. Doing one deal at a time was what I thought was the healthy way to not only focus our efforts on finding the best opportunities, but also grow our investors and the investment amounts at the same time. That's changing. We are, growing, and so is our investor base, and so is our expertise and our staff. So we will be moving towards doing more than one deal at a time, but I would say with caution, because I want to look back in 30 years and look at the business that I've built, not what I built in 5 years and then sold and moved on.
So you're a different type of entrepreneur than a lot of people that are looking from one thing to the next thing. You're here to stay with ArborCrowd.
Yes, very much so.
I love that. Is it mostly retail investors that you're working with, or is it also institutions?
We are only exclusively working with retail investors. We have investors ranging from retirees to people who actually work in real estate, which was ironically one of those things that fascinated me the most. Was when I started this business, I never realized how many real estate people would invest in our platform because they don't have the opportunity to invest with the principals of their firm. And they liked the way that we sourced deals and looked at deals. They liked how we approached things and ultimately the deals that we found. And they made the decision to invest with us. I had no idea that would be the reality of what started to happen. It is a part of our investor base, and we're very proud of it.
I like that. I think that speaks to the idea of real estate crowdfunding in general, is that it does crack open commercial real estate, as so many people see those deals out there, and it's like there is a way to get in now.
Yeah, definitely. Accessibility is huge, and I can't say it enough. And if people have the ability to make the investment online and have access to the information, all the power to them. And I hope that just keeps happening to a larger degree.
So what advice do you have for someone who may be accredited, they've looked around, they have a stock portfolio? What should they be thinking of before they make their first deal? Should they be planning to do multiple deals at the same time?
I would always caution to not bite off more than you can chew. So it really depends on your own experience and your own personal level of comfort, and also how much capital you're looking to allocate. I think diversification in real estate in general is incredibly important. So I strongly encourage it. With crowdfunding, you have a unique ability to really hand select some of the opportunities. And that's what doesn't exist in the real estate space. You have access and you have selection. But that comes with caution. Do your homework, do your research, try to speak to representatives, join the webinars, access the information. Again, you don't have to become the ultimate expert in real estate, but you should feel comfortable knowing that your questions can be answered at whatever level they are. And I strongly encourage it.
What do you think about some of the trends that we're seeing right now that are capturing kind of media and investor attention? We've got NFTs out there, more talk about tokenization of real estate and putting real estate on the blockchain. I feel like I've been having that conversation for years. It hasn't really come of anything. What are you thinking? You see a lot of these types of structures coming in. What's your take?
I know they're happening, and I read about them here and there, but they're on the periphery to me too. I'm a bread and butter kind of person. I like to focus on what we know and what we do best. I think the industry undoubtedly will move there. And when it does, I will probably be more familiar at that point in time, but it's not my focus right now. I love the tangibility of real estate, and I like to keep the tangible aspect of it all the way around. That's our focus. That's my experience.
I love how cautious you are. All right, last question for you. Where would you like to see ArborCrowd in 5 years? I know you've got the 30-year plan. What does the 5 and 10-year plan look like?
I think we are going to heavily explore the single-family rental market and the build-to-rent space. I think that it is a tremendous focus of ours to partner up with the right people, which we're doing, and become foremost experts and leaders in that space, which we're also doing as we speak. I think that's part of our plan, and potentially to open up to a couple more product types outside of that in ways that we're exploring, and hopefully we'll launch soon.
Does that mean other sectors, perhaps?
Maybe other types, other areas of the capital stack, maybe, but not across sectors.
Okay, interesting. All right. Well, that is a great place to end things. Thank you so much for your time. Reminder to listeners, you can always learn more at ArborCrowd.com. You can also read the review on our site, as I mentioned at the top of the podcast. You can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.